What you're about to hear is going to sound impossible, but I need you to stay with me, because what's happening right now in the gold market isn't just another price move. It's the beginning of something that financial historians will be writing about for the next 50 years. Right now, as I'm recording this, gold is trading near all-time highs. But here's what almost nobody is telling you. This isn't the top. This is the starting gun. And the people who understand what's really happening, the central banks, the sovereign wealth funds, the family offices managing generational wealth, they're not selling. They're accelerating their buying at a pace we've never seen before in modern history. Let me show you what I mean. When you look at central bank gold purchases, something extraordinary is happening. These aren't retail investors chasing momentum. These aren't speculators looking for a quick trade. These are the most sophisticated financial institutions on the planet, the ones with access to information and analysis that you and I will never see. And they're buying physical gold like their currencies depend on it, because frankly they do. The People's Bank of China has been on an unprecedented buying spree. Month after month, they're adding to their reserves. But here's the thing that should make your ears perk up. They're almost certainly buying more than they're reporting. Why would they do that? Because if the world knew the true extent of their accumulation, it would trigger the very price explosion they're trying to front-run. They're playing chess while everyone else is playing checkers. Poland's central bank governor came out recently and said something that should have made headlines everywhere, but it got buried in the noise. He said they're looking to increase their gold reserves significantly because, and I'm paraphrasing here, the international monetary system is changing in ways that make gold essential for national security. National security. Let that sink in. He's not talking about investment returns. He's talking about survival. But let's go deeper, because this is where it gets really interesting. You know what the Great Reset actually is? It's not some conspiracy theory. It's the recognition by every major financial power that the current system, the one built at Bretton Woods after World War II, the one that made the dollar the world's reserve currency, that system is breaking down. And when systems break down, there's always a reset. Always. The only question is what comes next. Here's what most people don't understand about monetary resets. They don't happen overnight with some dramatic announcement. They happen gradually, then suddenly. Right now, we're in the gradually phase. Countries are quietly diversifying away from dollar reserves. Trade agreements are being rewritten to bypass the dollar. The BRICS nations are building alternative payment systems. And at the center of all of it, like the sun in our solar system, is gold. Before I go further, I want to mention something quickly. I've put together a free guide that breaks down the saving secrets thousands of American retirees are using right now to protect their wealth from exactly what I'm describing. It's in the description below. No cost, no obligation, just information that could be crucial for your financial future. Grab it while you're thinking about it, then come right back, because what I'm about to show you next is the real bombshell. Now let's talk about what's happening in the physical gold market, because this is where the story gets absolutely wild. There's a growing disconnect between paper gold and physical gold. What does that mean? It means the price you see quoted, the spot price, that's largely determined by paper contracts, futures, derivatives, financial instruments that represent gold but aren't actually gold. It's like the difference between a deed to a house and the actual house. And right now, there are way more deeds than houses. The COMEX, the major exchange where gold futures trade, operates on something called fractional reserve. They don't have enough physical gold to deliver on all the contracts if everyone demanded delivery at once. It's the same principle as fractional reserve banking. And just like banking, it works fine until it doesn't, until there's a run. And we're starting to see the early signs of that run. Look at what's happening with gold ETFs. For years, these were the easy way for institutions to get gold exposure without dealing with physical metal. But something changed. The smart money started draining gold out of ETFs and taking physical delivery. Why? Because they're worried about counterparty risk. They're worried that in a real crisis, paper claims on gold won't be worth the paper they're printed on. They want the actual metal in their vaults, under their control. There's a story I want to tell you that perfectly illustrates what's happening. Back in the early 2000s, there was a German politician who started asking questions about Germany's gold reserves. Germany had massive gold holdings, but most of it was stored in New York at the Federal Reserve. This politician wanted to know, is our gold actually there? Can we see it? Can we audit it? The response was telling. The Federal Reserve said, sure, you can have your gold back, but it's going to take 7 years. 7 years to return gold that was supposedly sitting in a vault ready to go. Why 7 years? The official explanation was logistics, security, transportation, but a lot of people started wondering, do they actually have the gold, or do they need 7 years to acquire it? Germany eventually got their gold back, or at least some of it. But the episode revealed something important. Physical gold, real metal that you can touch and hold, is becoming increasingly precious. And the gap between paper promises and physical reality is widening. Now let's talk about what this means for price. When you have increasing demand and constrained supply, basic economics tells you price has to rise. But we're not talking about normal supply and demand here. We're talking about a fundamental shift in how the global financial system operates. And that means the price moves we're going to see won't be normal either. Major investment banks are putting out price targets that would have seemed insane just a few years ago. We're seeing forecasts for gold pushing toward $5,000 per ounce, with some analysts suggesting $6,000 or even higher is possible in the coming years. But here's what you need to understand. These aren't wild-eyed gold bugs making these predictions. These are the same institutions that have historically been skeptical of gold, the ones that have told their clients to stay in stocks and bonds. When they start talking about $5,000 gold, you need to pay attention. What's driving these forecasts? It's a perfect storm of factors that are all converging at once. You've got central banks buying, you've got geopolitical tensions that make hard assets more attractive. You've got inflation that's proving far stickier than anyone wanted to admit. You've got currency debasement happening on a scale that would have been unthinkable a generation ago. And you've got a growing recognition that the financial system as we know it is in transition. Let me paint you a picture of what this transition looks like on the ground. Imagine you're a finance minister in a mid-sized country. You've got reserves in dollars, euros, maybe some yen. You're watching the United States run trillion-dollar deficits with no end in sight. You're watching Europe struggle with energy crises and economic stagnation. You're watching Japan try to manage debt levels that are literally off the charts. What do? You can't just dump your dollar reserves. That would crash the market and destroy the value of what you're trying to protect. But you can gradually, quietly shift your allocation. You can buy gold. You can diversify into other currencies. You can build relationships with other countries to trade in local currencies instead of dollars. And that's exactly what's happening all over the world right now. The BRICS nations, Brazil, Russia, India, China, South Africa, they're not just talking about alternatives to the dollar anymore. They're building them. They're creating payment systems. They're discussing a common currency. They're settling trade in their own currencies. And every one of these initiatives reduces demand for dollars and increases demand for gold as a neutral reserve asset. Here's something that should terrify anyone who's paying attention to monetary policy. The United States has added more to its national debt in the last few years than in the entire history of the country before that. Think about that. More debt in a few years than in all the decades and centuries before combined. How do you pay that back? You don't. You can't. The only way out is to inflate it away, to make the dollars you owe worth less than the dollars you borrowed. And that's exactly what's happening. But inflation isn't just an American problem, it's global. Every major central bank printed money on an unprecedented scale. They called it quantitative easing, asset purchases, emergency liquidity measures, but at the end of the day, it was money printing, and that money is still in the system, sloshing around, looking for a home, driving up prices of everything from houses to stocks to, yes, gold. Now, I want to take a moment here because this is important. If you're sitting on retirement savings of $100,000 or more, you need to understand how gold can fit into your wealth protection strategy. I've put together a comprehensive guide on gold IRAs, how they work, how you can get physical gold into your retirement account without triggering tax penalties, how to evaluate custodians and storage options. It's in the description below. This isn't about fear-mongering. It's about having options. It's about understanding how to hedge against the exact scenarios I'm describing, market instability, currency debasement, geopolitical chaos. The guide is free, it's educational, and it could be one of the most important things you read this year. Check it out when you get a chance, but let me continue, because we're just getting to the really critical part. Let's talk about what happens when the paper gold market breaks. And I'm not saying if, I'm saying when, because the mathematics of fractional reserve gold trading make it inevitable. You've got a system where the same ounce of gold is claimed by multiple parties. You've got leverage ratios that would make a casino blush. You've got a market structure that depends on most people never asking for physical delivery. What happens when that changes? History gives us some clues. In the 1970s, when the gold standard finally collapsed completely, gold went from $35 an ounce to over $800. That's not a 20% move. That's not a double. That's a 20-fold increase. And it happened because the fundamental relationship between gold and currency had to reset. We're facing a similar reset now, but on a much larger scale, with much more currency in circulation, with much more debt in the system, with much more at stake. The difference between then and now is that in the 70s, gold was still a major part of the monetary system. Central banks held it. It was still referenced in currency agreements. There was still institutional memory of gold as money. Today, we've had 50 years of fiat currency dominance. Entire generations have grown up never thinking of gold as money. But that's changing. And when the collective consciousness shifts back to recognizing gold's monetary role, the repricing is going to be spectacular. Let me tell you about something called Gresham's Law. It's an old economic principle that says, bad money drives out good money. What does that mean? It means when you have two forms of money in circulation, one that's being debased and one that holds its value, people hoard the good money and spend the bad money. You save the gold and spend the dollars. And that's exactly what we're seeing now on a global scale. Countries are hoarding gold and spending dollars. Institutions are hoarding gold and spending dollars. Smart individuals are hoarding gold and spending dollars. This creates a feedback loop. As more people recognize what's happening, demand for gold increases. As demand increases, price rises. As price rises, more people pay attention. As more people pay attention, demand increases further. It's a cycle that feeds on itself. And we're in the early stages of that cycle right now. But there's another factor that most people aren't considering: mine supply. Gold doesn't just appear out of thin air. It has to be dug out of the ground, refined, processed. And gold mining is getting harder, not easier. The easy deposits have been found. New discoveries are rare. Ore grades are declining. Costs are rising. Environmental regulations are tightening. Political risks in mining jurisdictions are increasing. All of this means that even as demand is surging, supply is constrained. The mining industry can't just flip a switch and produce more gold. It takes years, sometimes decades, to bring a new mine online. You have to find the deposit, which is increasingly difficult. You have to secure permits, which is increasingly time-consuming. You have to raise capital, which is increasingly expensive. You have to build infrastructure, hire workers, deal with community relations, environmental concerns, political instability. By the time a new mine is producing, the market conditions that justified it may have completely changed. This supply constraint is one of the reasons why gold is different from almost every other commodity. When oil prices rise, producers can drill more wells relatively quickly. When copper prices rise, mines can increase production. But gold supply is essentially fixed in the short to medium term, and that means price has to do all the work of balancing supply and demand. Now let's talk about what this means for the average person, for retirees, for people trying to preserve wealth they've spent a lifetime building. The traditional 60-40 portfolio, 60% stocks, 40% bonds, that model is breaking down. Bonds aren't providing the safety they used to because interest rates have been manipulated so low for so long that there's no cushion. Stocks are trading at valuations that historically have preceded major corrections. Real estate is priced for perfection in many markets. Where do you go for safety? Gold has historically been the answer to that question. Not because gold produces income or dividends, not because gold is going to make you rich overnight, but because gold maintains purchasing power over long periods of time. An ounce of gold today buys roughly the same amount of goods and services that an ounce of gold bought 100 years ago. Can you say the same about a dollar? About any fiat currency? Think about it this way. If your grandfather had put $1,000 in a bank account in 1920, what would it be worth today? Even with interest, it would have lost massive purchasing power to inflation. But if he'd bought gold with that $1,000, he'd be sitting on a fortune. That's the power of gold as a long-term store of value. It's not about getting rich. It's about not getting poor. And that's what the Great Reset is really about. It's about a recognition that the current monetary system, based on unlimited currency creation, backed by nothing but government promises, isn't sustainable. It's about a return to the understanding that real money, money that can't be printed, money that has intrinsic value, money that has been recognized as valuable for thousands of years, that money is gold. The institutions know this, the central banks know this, the sovereign wealth funds know this. The question is, do you know this? And more importantly, are you positioned for what's coming? Let me give you another historical parallel. In the early 1900s, most major currencies were backed by gold. You could take your paper money to a bank and exchange it for actual gold. That system, the classical gold standard, broke down during World War I when governments needed to print money to finance the war effort. They suspended gold convertibility, promising it was temporary. It never came back, not really. What followed was a period of monetary chaos. Currencies fluctuated wildly. Some countries experienced hyperinflation. The German mark became worthless. People needed wheelbarrows full of cash to buy bread. And through it all, gold maintained its value. People who held gold survived. People who held paper currency were wiped out. We're not in Weimar Germany, but the principles are the same. When currency loses credibility, people flee to hard assets. And the hardest asset, the one with thousands of years of history, the one that every civilization has valued, is gold. Now here's where it gets really interesting from a market mechanics perspective. The gold market isn't like the stock market. It's much smaller. The entire above-ground stock of gold, everything that's ever been mined in human history, is worth somewhere in the range of $12 to $15 trillion at current prices. That sounds like a lot until you compare it to global stock markets, which are worth over 100 trillion, or global real estate, which is worth even more, or global debt, which is approaching 300 trillion. What happens when even a small percentage of that wealth tries to move into gold? The price has to rise dramatically, because there simply isn't enough gold to absorb that demand at current prices. It's basic supply and demand, but on a scale that's hard to comprehend. And this is already starting to happen. We're seeing it in the premiums for physical gold, over spot prices. We're seeing it in delivery delays. We're seeing it in the drawdowns of gold from ETFs as people take physical possession. We're seeing it in the buying patterns of central banks. All of these are signs that the market is tightening, that physical gold is becoming harder to obtain, that the gap between paper and physical is widening. There's a concept in markets called price discovery. It's the process by which markets determine the true value of an asset. But price discovery only works when markets are free and transparent. When you have massive intervention, when you have paper markets that dwarf physical markets, when you have central banks manipulating interest rates and currency values, price discovery breaks down. The price you see isn't the real price. It's a distorted price, a manipulated price, a price that doesn't reflect underlying reality. What happens when that distortion becomes too great? The market breaks. And when markets break, they reset, sometimes violently, sometimes overnight. And the people who are positioned correctly before the break, they're the ones who preserve and grow their wealth. The people who aren't, they're the ones who get wiped out. I'm not trying to scare you. I'm trying to prepare you. Because what's coming isn't a maybe, it's a when. The mathematics of the current system don't work. The debt levels aren't sustainable. The currency creation isn't sustainable. The political tensions aren't sustainable. Something has to give. And when it does, gold is going to be the asset that people flee to. Let me tell you about a conversation I had with a fund manager who oversees billions in assets. This is someone who's been in the markets for 40 years, who's seen every crisis, every boom, every bust. And he told me something that stuck with me. He said, "I've never been a gold bug. I've always thought gold was a barbarous relic, something for conspiracy theorists and doomsday preppers. But I'm buying gold now, not because I want to, because I have to, because I don't see any other way to protect my clients' wealth from what's coming." That's the shift that's happening. It's not the fringe anymore. It's the mainstream. It's the smart money. It's the people who have the most to lose, recognizing that the old playbook doesn't work anymore. And here's the thing about gold that makes it unique. It's nobody's liability. When you own a stock, you're depending on a company to perform. When you own a bond, you're depending on a government or corporation to pay you back. When you own real estate, you're depending on property rights being respected, on taxes not becoming confiscatory, on the local economy remaining stable. But when you own gold, you own an asset that has value, independent of any institution, any government, any promise. It just is. That independence is becoming increasingly valuable in a world where institutions are losing credibility, where governments are drowning in debt, where promises are being broken. Gold doesn't promise anything. It doesn't need to. It's been valuable for 5,000 years. It'll be valuable for the next 5,000. Now let's talk about timing, because that's what everyone wants to know. When is this going to happen? When should I buy? When will gold hit 5,000, 6,000, 8,000? And the honest answer is, I don't know exactly. Nobody does. But what I can tell you is that the setup is in place. The fundamentals are aligned. The institutional buying is accelerating. The supply constraints are real. The monetary instability is increasing. All the ingredients are there. In markets, there's a saying, the trend is your friend until the bend at the end. Right now, the trend in gold is up. It's been up for years. And every time there's a pullback, it gets bought. Every time there's a dip, central banks step in. Every time skeptics say it's topped out, it makes new highs. That's not random. That's a bull market. And bull markets, especially in gold, can last much longer and go much higher than anyone expects. Think about the last major gold bull market, the one that ran from 2000 to 2011. Gold went from around $250 an ounce to over $1,900. That's more than a 7-fold increase. And it happened during a period when central banks were actually selling gold, not buying it. Imagine what happens in a bull market where central banks are aggressive buyers, where geopolitical tensions are higher, where currency debasement is more extreme, where the recognition of gold's monetary role is spreading. The potential isn't just for gold to double or triple. The potential is for a complete repricing of gold relative to fiat currencies, a recognition that the real value of gold hasn't changed, but the value of currencies has collapsed. And when that recognition becomes widespread, when it moves from the margins to the mainstream, the price moves are going to be unlike anything we've seen in modern markets. I want to come back to something I mentioned earlier, the difference between paper gold and physical gold. This is crucial to understand. When you buy a gold ETF, you own shares in a fund that claims to hold gold. When you buy gold futures, you own a contract that gives you the right to take delivery of gold at some point in the future. But in both cases, you don't own gold. You own a financial instrument that represents gold. And in a crisis, that distinction matters enormously. There have been cases where gold ETFs have had to suspend redemptions because they couldn't source physical gold. There have been cases where futures contracts have been settled in cash instead of metal because there wasn't enough gold available for delivery. These aren't theoretical risks. They're real events that have happened in recent history, and they're going to happen more frequently as the physical market tightens. That's why the smart money is taking physical delivery. That's why central banks are repatriating their gold, bringing it home from foreign vaults. That's why there's a growing premium for physical metal over paper claims. Because in the end, possession is 9/10 of the law, and in a monetary reset it might be 10/10. Let me give you one more piece of the puzzle: interest rates. For years, one of the arguments against gold was that it doesn't pay interest. Why hold gold when you can hold bonds and get a yield? But that argument only works when interest rates are positive in real terms, when they're higher than inflation. And right now, in most of the world, they're not. Real interest rates, the rate you get minus inflation, are negative, which means you're losing purchasing power by holding bonds. In a negative real rate environment, gold shines, because even though gold doesn't pay interest, it doesn't lose value to inflation the way bonds do. It maintains purchasing power. And as more investors recognize this, as more capital flows out of negative yielding bonds and into gold, the price pressure is going to be immense. Central banks are trapped. If they raise rates high enough to get positive real yields, they'll crash the economy and make their massive debt loads unsustainable. If they keep rates low, they fuel inflation and destroy the value of their currencies. It's a no-win situation. And the only way out is through a period of financial repression where savers are slowly bled dry by negative real rates, or through a crisis that forces a reset. Either way, gold wins. In the slow bleed scenario, gold preserves purchasing power while everything else loses value. In the crisis scenario, gold becomes the safe haven that everyone flees to. There's no scenario where the current policies continue indefinitely without consequence. The math doesn't work. The economics don't work. The politics don't work.